Hello, my name is Steve Bennett, Direct CEO here at Charter Hall. And today I'm joined by Charter Hall's Managing Director and Group CEO, David Harrison, who's going to talk about how the Australian office market is performing, where our Charter Hall Direct Office Fund is positioned in the market, and importantly, the outlook for the office market moving forward. We've seen significant changes in office markets in recent years, including tenant customer preferences and office valuations. David, where are we at in the cycle?
I think first of all, fundamentals are pretty good for office. Our portfolios stay at quite a high occupancy level. The tenant composition that we've curated over the years is giving us a pretty good tenant roster, rental growth between both locked-in, contracted annual increases and market rental growth. And the team have done quite a lot of work on curating our portfolios over the last 18 months. So the way I look at the office market now, it's going to be quite a bifurcation between modern, well-located assets and older stock. Over $500 million of DOF assets have been sold over the last 12 months so that we can curate that portfolio. And we're looking forward to December 24 pretty well being the trough of asset valuations. We all know interest rates have risen quite a lot in the last few years. They look like they've peaked. We have an expectation that they'll start falling during 25. And when that happens, we're going to start seeing asset values not only grow in line with income growth, but potentially the cap rates that we've seen rise in the last couple of years start to fall, and that will create some amplified growth in asset values.
We know that not all office property is the same, and we believe that high quality, well-located office will continue to perform over the longer term. Can you give us your view on how the DOF portfolio is positioned in the current market?
Well, I think as I said earlier, DOF has been curating its portfolio. If you look at some of the assets we've sold in Melbourne, they're quite old buildings. One was built in the 50s. It's been a good performer for DOF over the years, but there's a time when you need to curate your portfolios. When I look at what we've got left in DOF, they're predominantly modern assets, well located, good tenants, and healthy average lease terms to expiry, or what we call WALE. And importantly, we've got contracted rental growth locked into those assets. Looking forward, many of the markets have hit a stabilisation period. We think the whole of Sydney CBD will outperform over the long term. And I think we also have what I call institutional tenant rosters in the DOF portfolio, which is going to give it a point of difference in this bifurcation of tenant demand, which I think will lead to a bifurcation of capital demand for office assets. So overall, I think DOF's in pretty good shape. I'm a DOF investor. I certainly am going to continue to invest for the longer term. And when I look at where we are in the cycle, and this is trough pricing, we can enjoy continued solid distributions and asset value growth going forward.
You mentioned earlier that it's been a very challenging time in the office market over the last 2.5 years. What is the outlook for the Australian market as we go forward?
Well, I think one of the things I've seen in my 37 years in real estate is when your investment values are well below replacement cost, that creates a pressure cooker on asset values. Virtually all of our DOF assets are well below what it would cost to replace those assets. That means that tenants are going to have to pay much higher rents to commit to new buildings, and therefore that puts pressure on existing building rents. The other thing I'd say is, as we're seeing with state governments and many corporates, with mandating back to working in the office after a few years of work from home, we think that will continue to increase the demand for office. We've actually seen the average workspace ratio, or number of square metres per person, rise in the last couple of years from pretty low levels of around 10 square metres per person to around 13 square metres per person. So that, combined with the general growth of corporates, given that Australia's got one of the highest population growths in most Western markets, augurs well for a pretty solid outlook outlook for the office markets. The other thing I would say is that we are seeing a continued rise in construction costs, so that means that the development costs to build new buildings is very challenging to make work for developers. So you're going to see a contraction of new supply, and what happens when you have a contraction of new supply with continued demand, ultimately something has to give, and that is in the form of rental growth and asset value growth. So I don't think the office markets are dead. We at Charter Hall are quite high conviction on good quality office going forward, and in a relative sense, the cap rates or initial yields and total returns that can be delivered on office from today's values are very competitive versus most other sectors. So that's going to mean capital at all ends of the capital stack is going to continue to be quite constructive about further investment in office. So I think the outlook is pretty good. Yes, it's been a tough couple of years, but I think we and our investors should have strong conviction on the outlook for good quality office going forward.
Thank you for joining us. If you'd like more information, please reach out to a member of our team. Thank you.